a.m. in Sydney, 10 a.m. in San Francisco. Wishing you a great day on the West Coast, and 10:30 at night in Mumbai. Good morning, good afternoon, good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO video livestream, episode 9, starts here. The Nobel Prize for Economics has come the closest to the parish of exchanges since, I believe, the memorable win by Merton and Scholes in 1997. Congratulations to Paul Milgrom and Robert Wilson on their work pertaining to auction theory. Meanwhile, across the big world spectrum, perhaps the biggest idiocy of the NGO cum government blob itself, the Stockholm Syndrome result of Conquest's law of politics, is the ongoing belief that the nation state can trap taxpayers and keep them hostage. Ironically, it does affect the bourgeoisie locked into the professions, but for everyone else, an element of the free agent pertains. For decades, I've been noting that this trend would become a major issue. Perhaps I'm touching, well, close to the phenomenon of socionomics, but let's get back to that later in the discussion today, as our expert guest is an acknowledged forerunner and thought leader in that field, Murray Gunn, to whom we'll be speaking in just a moment. However, meanwhile, that whole COVID time press for taxation has ended up with, interestingly enough, becoming a huge counterpoint in none other than the exchange world. But at the same time, of course, governments are holding us hostage. I suppose the one area where declining Europe is evidenced by the EU might be able to claim leadership is by being an early mover in the explosion of this debt crisis. John Holzman in City AM this week notes how the Eurozone inflation rate was negative 0.3% in September. That's after a negative 0.2% rate in August. In Southern Europe, the September deflation rates we're now at was negative 2.3% in Greece, negative 0.9% in Italy, and negative 0.6% in Spain. The net result, Holzman notes, is that, and I quote, "Soon Italy and Spain will be little more than ECB economic colonies, as the bank has already borrowed a gargantuan 25% of Italian debt, with that number expected to skyrocket to 50% by next year." I suppose my concern is that even with the ECB owning 50% of Italian debt, with what must surely be the most elastic balance sheet of all time, that would leave almost still 100% of Italian GDP in debt terms to be funded by actual bond buyers, investors, if you like, as Italian GDP, even on the perma-optimistic numbers of the OECD, will leave Rome the capital of 192% debt to GDP by the end of next year. Of course, Greece at 229% is expected to be, well, a great deal worse indeed, but at least that's not so economically systemic to the Eurozone's survival. However, with France and Spain expected to have debt to GDP of 152% and 150% respectively, well, at this stage, I suppose, governments start to look like a man in quicksand. And as that old cartoon of two explorers up to their necks in the thing go, "Do you know, I'm supposed to stop moving, sir, but I'm inclined to wiggle." And how might that wiggle go? Well, clearly there is a finite amount of debt investors can buy. Arguably, even fiscal gravity will eventually come to haunt the central banks like the ECB. Thus, in the short term, of course, the first desperate act of any addict is to seek funding for another hit through an easy money grab, aka higher taxes. The UK's brief outbreak of government during 2019, roughly speaking, it was called last December, has given way to another limp farrago of apathetic posturing on the fiscal front run by another toothless, posh-sounding bloke. The US overspends everywhere on the cusp of choosing mad or bad as president, and the federal government is, if anything, a slouch compared to many states and municipalities. Europe, it goes without saying further, the capital of the Federation of Kyrgyzstan is, as I mentioned earlier, more bankrupt still. The above, incidentally, is not meant to be a political diatribe. It simply amounts to economic gravity. Politicians do what they can get away with. I'm just an investor who seeks to make a return without being destroyed by the machinations of the spendthrift or indeed the manipulations of central bankers. A first sign of pushback has emerged from none other, as I mentioned earlier, the parish of exchanges, where, as you may know, I publish the unique daily business newsletter and analysis, Exchange Invest, read daily by all the most influential in the business of bourses. More information on that, of course, at exchangeinvest.com. Amongst the parish, NASDAQ have been mentioned to be looking for a more sustainable base for trading than the anyway reaching capacity of power supply, at least New Jersey data centres, which some smart aleck in the political firmament thought could easily be taxed because they're fixed properties. Of course, you can't roll up a data centre and take it away. And here the political classes have shown us how analogue they are. The difficulty is you can move the data. You can move the data very quickly. And even if you want to build more data centres, well, it's really more a play on planning permission than the great scheme of things, rather than actually a huge effort in industrial economics, as I know from sitting on the board of a data center some years ago. Now, even allowing for the fact that NASDAQ is taking, by the looks of it, that long and sustainable route, while seeking a whole new mega infrastructure to use for the next trading generation, which may well end up being situated in and around Dallas-Fort Worth in Texas. Yeehaw! NASDAQ underlines the common analog assumption of government in a digital age, and it undermines it. A static tax base, there is not in the digital age in any way, shape, or form. That underpinning isn't remotely as big as blobsters think it is, and when they threaten it with taxation or excessive regulation, ultimately whatever bonds may remain within domicile region can be broken through the incentive of better living standards elsewhere. That the likes of New York City and London, to name but two cities, are declining into hotspots of crime akin to the 1970s, only accelerate the taxation concern issues. That leaves a major concern, as currently no Western government has even the remotest scintilla of understanding that their spendthrift ways are hugely endangered. If confidence in funny money takes even a remote hit, civilization might turn out to be the hundreds of miles away from the white picket fence you were used to calling home. Certainly, the servers where the business is done will be. That arc of the macroeconomy from taxation to investment brings me neatly to today's guest. Murray Gunn is a doyen of the technical analysis world. We first met, as Murray was reminding me just yesterday, in 1998 in Rome, the capital of Italy, and of course the usual place where folks who were born in Edinburgh and Belfast are wont to be introduced, at a conference of the International Federation of Technical Analysts. Murray has been a professional technical analyst and fund manager for, getting on for 30 years now. I know, ladies, he does not look remotely that old, with significant experience at Standard Life Investments and the Abu Dhabi Investment Authority before becoming head of technical analysis at HSBC Bank. Murray is the author of the book Trading Regime Analysis, The Probability of Volatility, published by Wiley, and he served on the board of the Society of Technical Analysts, the foremost body in the United Kingdom for those who like following charts, such as indeed myself. Moreover, as I mentioned earlier, in the terms of the frame of socioeconomics, Murray is a founding member of the Socioeconomics Foundation, believing that social mood is the driver of economic activity and the cycles of inflation and deflation. He sees broad similarities between the Austrian School of Economics, the likes of the good folks such as von Mises, and of course the great Mr. Hayek, and the cyclical views expressed by the likes of Charles Dow, Ralph Nelson Elliott, and Hamilton Bolton. Murray, good evening. Welcome. You are live on IPO Video. Where in the world are you today?
Good evening, Patrick. Thank you very much for inviting me. Great to see you again after all these years. And I am in the great county of Essex, just outside London, just to the east of London. And it's been a very rainy day, but that hasn't put me off with my enthusiasm for the markets as normal. But yes, I've been in Essex for around 10 years now. And as you were alluding to, with my Scottish roots, I think there's a lot of similarities between people from Essex and people from Scotland. We both have a similar sense of humour and a similar sort of anti-establishment rebellious streak as well. So I think I fit in here quite well.
So with that rebellious streak in mind, I mean, tell us a little bit about your career, because you studied, I do believe, the dark art and science of economics, and then very quickly became a technical analyst.
Yes, well, like most technical analysts, I started on the fundamental side. It's funny, pretty much all technical analysts started as fundamental analysts or economists, and yet most economists and fundamental analysts never really study technical analysis at all. So there's a real dichotomy there, and it gives us an advantage because it means that we know both sides of the fence, if you like. And yes, so I came into the markets back in 1991 after graduating in economics, and believed the markets would act the way that the economic textbooks told us they would, and of course realized within about a week that they didn't. And that sent me on a course of thinking and scratching my head and thinking, well, if all, looking at, say, corporate stocks, if all the news was good, the balance sheet was good, the profit and loss was really good, and the results were good, why did the share price go down? And I thought, well, something else must be at play here. And that's what got me thinking about the more what's driving the stock market, what's driving markets, financial markets in general. And that's what led me down to technical analysis, the more behavioral aspects of things, and pretty quickly into the Elliott Wave principle. Most people go through a journey when they get into technical analysis. They look at all sorts of aspects of technical analysis, Dow theory, Elliott Wave principle, indicators, the whole gamut. And people kind of come on to their own way of looking at things eventually. And certainly for me, after my years of experience, I've certainly realized that the Elliott Wave principle is the aspect of technical analysis which underpins everything else.
Fabulous. So let's take that back a second. By the way, ladies and gentlemen, Murray's going to be talking about the theory of Elliott Wave for a few minutes, and then we're going to go run through some charts about markets and so on. If you've got any questions, then do please send them to us in the chat. Murray will be delighted to talk his way through various things about markets at the moment. Ralph Nelson Elliott, give us a little bit of a background on this fascinating man, Murray.
Well, you're right. He was a fascinating man. He, for most of his career, he was a top accountant. A lot of the time with the U.S. government, and spent a lot of time in Central America, specifically in the railroad industry. And so he had an accountant's brain. Then back in the 1920s, was back in the US, and he became an advisor to tea rooms. He became a kind of a tea room entrepreneur. And if you think that tea rooms back then were the equivalent to Starbucks and Costa Coffee and everything is now, then it was big stuff. So he was very interested in business. Then after the Wall Street crash in 1929, he was really scratching his head. He was suffering from a bit of an illness that he had picked up on his travels throughout his career. And so what he did, he set upon an empirical study of stock market data, using his accountant's forensic skills. Got all the data and just studied what the market was telling him. How did the market actually act? How did it behave? And he didn't come in with any pre thoughts about pre biases about how the market should act. And what he discovered was quite incredible, really, and well before its time. He discovered that the market swings between periods of pessimism and optimism, and these movements in the market, he called them waves. They repeat at every time scale. So what he discovered was really that the market is a fractal. He discovered that there was a basic set of patterns, and there's a basic structure to the market. Let me just put on a chart here, and I'll show the viewers.
Look at it if I can.
Hopefully you can see that.
Yes, we certainly can. The Elliott Wave principle.
Yeah, so here's Mr. Elliott up here on the left. And so this is the basic design of Elliott's discovery. And so what he discovered, the market advances, if we're talking about a bull market in the stock market, the market advances in 5 waves. So if we can see here, wave 1 in the circle, wave 2 in the circle, wave 3 in the circle, hopefully you can see my cursor moving here, 4 and 5. So it's a 5-wave movement higher, and then it corrects in the what Elliott called the corrective wave in a lettered phase, A, B, and C. Of course, he came up with the nomenclature himself for the Elliott wave principle. But the main discovery really was the fact that wave 1 itself was split into 5 waves. So wave 1 in a bracket here, wave 2 in a bracket. But not only that, wave 1 in the bracket was split into 5 waves. Wave 2 was split into 3 waves. So you can see that the market repeats itself at every time scale. The market is a fractal. So you have this ongoing progression of the market, which means that, which does allude to the dividend theory of growth in the stock market. The stock market will always move higher over time, but there can be, what Elliott's discovery really meant was the fact that there can be extended periods of time when it doesn't. And that speaks to what we call the higher degree fractals. So if the market made 5 moves up in terms of these numbers here, then the market would have a corresponding bigger setback than in previous waves. But the basic design is also really interesting. His discovery was because the fact that, as you can see, these numbers here, these allude to the number of waves in the cycle, and all of these waves, all of these numbers are Fibonacci numbers, and of course that's related to the golden ratio, which goes back to Euclidean geometry, and it is the ratio that underpins the natural world of growth. And it's all around in nature, from sunflowers and Nautilus to galaxies. And it's amazing how what Elliott discovered was the fact that the market can be led naturally by this ratio. And so a lot of the time, waves will retrace to a certain level related to the golden ratio, and then reverse. A lot of the time, the market will extend to a price target, which is related to the golden ratio, and then reverse. It doesn't happen all the time, but what Elliott discovered was the fact that it happens a lot of the time. Now, one of the things, if we could just move on to this slide, which validates the Elliott wave principle, is the fact that Elliott's original drawings are shown here in one of his essays from 1940 to 1942, and you can see the basic design that Elliott had here. You have 5 higher degree waves up, wave 1 here split into 5 waves, and wave 1 here on the left hand side is split into 5 waves, etc., etc. And you can see how the market progresses. Now, so this was Elliott's drawing in 1940. In 1999, Benoit Mandelbrot, who is or was a famous mathematician and famous person in the markets, and a lot of the quant community certainly liked Mandelbrot's work. He wrote an essay in the Scientific American called A Multifractal Walk Down Wall Street, where he talked about fractals and how they led the market, how that was the market's design. He used charts almost exactly the same as Elliott's here, but it was obviously 1999 rather than 1940. So we certainly think that Elliott discovered that the market is a fractal system, and it was proven by Mandelbrot 60 years later.
6 years later. Fascinating altogether. So, I mean, looking at that between the work of Elliott and then its validation by Mandelbrot many years later, who was such a pioneering genius, really, of the whole quantitative financial movement in many ways in the analytical terms. How does that actually practically work in markets? Because, I mean, there's a lot of complexity there. I mean, one of the things you mentioned earlier was, indicators people go to and things like that. Well, of course, indicators are great because they just give you a number or a line. So they're more or less, they're the Bugs Bunny cartoon of technical analysis. I mean, they essentially hit you in the head with something. So therefore, it's pretty obvious what they're doing. Whereas Elliott Wave looks to me as if it could potentially be rather subjective.
Yes, this is the major, shall we call it a criticism? I think we can call it a criticism. It's the major criticism of the Elliott Wave principle is the fact that it appears to be quite subjective. We'll show some charts later on where we put labels on the charts, and that decides the outlook for the next period of time. Now, we don't just randomly label these labels. The Elliott Wave principle, Elliott had certain rules of wave formation. And so these rules can't be broken. So when an Elliott Wave analyst is looking at a potential wave count, as we call it, they have to adhere to the rules of wave formation and guidelines. So the understanding, it's very understandable that people get frustrated when they see a wave or a market labeled with a certain wave count, and then the price changes, and then the labeling changes.
Right.
Now, at any point in time, there will be 2 or 3 or even more potentially valid wave counts. That the job of the analyst is to work out based on not just the price action, but looking at, say, things like sentiment, as well, to give clues as to where we are potentially in the wave structure. Now, the way that I like to explain to people who find it frustrating is that I myself, I like trend following as an investment plan. As a long-term investment plan, trend following is a good, it's been proven to be successful. So, let's take the basic trend following system based on moving averages, for instance. Now, if you trade or you invest based on moving averages, nobody has any questions as to when the moving averages change. So, today the moving average could be positive, and you could be long the market. Tomorrow, the moving average could turn negative, and you could end up being neutral or short the market. And that's exactly the same as the Elliott Wave principle. When the price changes, the analysis has to change,
right?
Because there are rules involved.
So therefore, Elliott Wave could be argued as being Keynesian, because wasn't it Keynes who said he changed his opinion when the price changed? So sorry, that's slightly facetious, but interesting to see that Keynesian was really an Elliott Wave analyst, I suppose, in that sense. It's interesting because, I mean, actually, we already have a question from the audience, and they're asking, how did the waves behave during COVID? I mean, was that actually, has the incredible COVID shakedown still held up your faith in Elliott Wave theory?
Very much so, yes, indeed. We were telling Elliott Wave International, we're telling our subscribers coming into the end of last year that a top was probable in the major markets, and so it turned out we were, from just by looking at the price action, we were ready for a turn in the market. And of course, when the market falls, when the market moves quite dramatically, it's doing so on a huge focus on fear, or there's lots of emotions in the market. And of course, once you get lots of emotions in the market, that's when it can really bring out the wave forms themselves, because that's that's what drives markets. It's herding behavior that drives markets. And yeah, so when the market had exhausted itself in March, we were ready for that low as well. So yes, it's in times of fast moves, the Elliott waves actually can be very, very beneficial.
So actually, we've got a sort of extension of those questions already roaring in. Thank you very much, Martin Watkins, previous guest on this IPO-VID series. Martin, great to hear from you today. You're from somewhere towards the western side of London, I do believe, Buckinghamshire. So effectively, first of all, he's interested in a very historic thing. How did the Elliott wave perform during the Big Bang period when we had a huge structural reform to UK stocks? And he's also interested in what a check effect do you see when you have like contract changes, for example, changes in tick sizes or things like that. And then he's interested in the macro. What's been the effect of algorithmic trading? Has that still, despite all of that very, very, very hyper short-term noise, still made the Elliott wave valid? Very interesting questions.
Yeah, absolutely. I'll take the last one first. And we get asked this a lot as to whether computer trading. Well, I'm showing my age now. As we used to call it, computer trading, algo trading, I should say now, affects how things happen. Now, I can only go from my own experience back in when I was working with the Abu Dhabi Investment Authority. One of our jobs was to run models of investing and trading, and so we would run the models. And the thing is that you run the model, you create the model, you create the algo, if you like. A human being creates that algo and lets it run. But when things start to go wrong, or even if things start to go good, that's when human emotions start to come into it. And we had one particular model back then which involved with selling volatility, and obviously, at that time, back in the financial crisis, it started to underperform, and we turned it off. So, or we scaled it back a little bit. So, the bottom line is that human beings are responsible for what goes into a computer model, what goes into an algorithmic trading methodology. So, ultimately, human beings are still driving the market. So, in terms of how Elliott wave performed during the Big Bang period, very well. I'll just cite Robert Prechter, the dean of the Elliott Wave School for many decades and the president of Elliott Wave International. He was one of the only people that was bullish back in the late 1970s, early 1980s, as the market was coming out of its long-term sideways bear market, and called for a bull market of epic proportions during the 1980s. So the Elliott wave structure anticipated that bull market of the 1980s, and of course, you can see this all on the internet. But Robert obviously called the 1987 crash as well. So the Elliott waves can at that period showed that they can not only call the bull market, but also call when there's going to be a bit of a sudden correction as well. In terms of how does a change in the tick size affect things, I don't think it really affects anything that much. Perhaps maybe that's alluding to more people, more retail investors coming into the market. If the tick size is reduced and it makes it more accessible for retail investors to be in the market, that can have an effect very much as we're seeing at the moment. You look at all these minis and mini minis or super minis or whatever are coming into the market now. That's a sign of euphoria, and that's a sign of excessive optimism at the moment. And so one reason why we think the markets are set for a fall.
So Market set for fall. Shall we get to it? Shall we go? Wicker's world of technical analysis. A quick review of the markets.
Okay, well, let me just go through a few charts here and stop me if I'm going too slowly or quickly. Now, you and I will remember this from the 70s, the reruns of this from the 70s, Patrick, but the original Blob, I think they've made a remake of the Blob. I've not watched. I just remember the one with Steve McQueen in it, but it struck me that what's been happening over the last few decades really has been analogous to this movie, The Blob. It's indescribable, it's indestructible, and really nothing can stop it. So the thesis that we're working from is, at the moment, what's happening is there a super cycle top going on in the markets, and it's the blob of deflation. Now, most people think of deflation as you alluded to in your intro as well, as declining prices, like consumer prices or producer prices. And that's fair. I mean, that we would call that price deflation. In our view, the real measure of inflation and deflation is to do with the monetary side. So deflation would be a contraction in the amount of money and credit in an economy. Now, that is really that gets down to the age-old quantity theory of money. A lot of people are saying at the moment, obviously, we've had this huge increase in the money supply, the NT money stock in the US. Therefore, we're going to get a lot of price inflation. Well, just look at this chart and we can see that actually, even though the money supply has been well above the change in the CPI, CPI has really been subdued, certainly since QE started as well. And in actual fact, if you look at what's happening, if the Fed looked at this chart, they would stop printing money, okay? Because this shows the chart of the US core CPI, which is the blue line here, and M2 velocity, which is leading the CPI by 7 quarters. This is over the last 20 years. So the velocity can be thought of as the amount of times a dollar is changing hands in the economy, but it's basically the ratio of GDP divided by the money stock. So as the Fed prints more money, velocity goes down. So if the Fed looked at this chart, they would think, well, actually, what we're doing is self-defeating, because judging by this chart, if the relationship still holds, then the CPI, the rate of change in CPI, is set to fall quite dramatically over the next few months. So that's the monetary, the price side, if you like, of inflation. Yeah. What we're thinking about is more on the debt deflation side of things, which brings us to socioeconomics, as you alluded to. Now, this is Robert Prechter's theory that it's social mood that determines social actions. Most people think that social actions determine social mood, and in actual fact, it's the other way around. And one of the ways to think about it is to think about, say, war. People say, well, war makes people angry. That would be the standard way of thinking about things. A socioeconomic way of thinking about it would be that angry people make war. Another way to think about it is that recessions make business people cautious. The socioeconomic way of thinking about it would be that cautious business people cause recessions. So it's really turning the causality, on its head. So it's social mood, which is unconsciously driven through the herding behavior of society. And when we have a positive mood trend, people feel contented, optimistic. So society really reflects that mood. It's reflected in politics, and people feel lighter and happier. So therefore, popular culture reflects that. And also people buy stocks and take on debt. And this is why the stock market is what we call our sociometer, which is the measure of the social mood. And if we're in a positive social mood environment, the stock market will be going up. If we're in a negative social mood environment, the stock market will be going down. Here we are here with the slide just showing the other aspects to it. Now, one aspect I'll just touch on briefly, and I don't have the chart here, but I will really encourage viewers to look up socioeconomics.net, is that we have a study out at the moment, which is one of the most downloaded studies on the web right at the moment, showing the relationship between presidential elections and the stock market. And what it's actually saying at the moment is that it looks at the previous 3 years of performance of the US stock market and how that over the last 200 years has been related to whether the incumbent is re-elected or whether the challenger actually gets in. And what it's saying at the moment
is... what's the result? Go on, give us a clue. What does that tell us?
Well, at the moment, contrary to what all the polls are saying, at the moment, it's basically saying if the stock market stays around these current levels, then Trump is actually a favourite to be re-elected. It's moving between strong favourite and mild favourite at the moment, but that is what the socioeconomics is saying. That's what the history of the stock market and socioeconomics has told us. So that's going to be quite fascinating to see what happens. If the stock market has if social mood drops off in the next 3 weeks, then Trump becomes less probable to be re-elected, and Biden becomes more probable to be elected. So I would encourage viewers to look at socioeconomics.net on that one. But essentially, what we're saying really is that debt deflation is what we're concerned with. And it happens, I mean, obviously, there has been a huge amount of increase in debt over the last few decades. Everyone knows about that, and we've been talking about it for decades. When does it break? Well, it breaks when there's been a buildup of excess credit and social mood starts to turn negatively. So, here's what happened in Japan. Obviously, we had this massive positive social mood in the 1980s, and then a period of negative social mood reflected in the fact that the Nikkei was falling. So it started falling from the 1990. Now, this is what happened to the Japanese private sector debt at that time. So as the economy started to contract in the early 1990s, private sector debt as a percentage of GDP actually went up a little bit, as you would expect, given the mathematics of it. But after that, it really went into a long-term 2.5 decades worth of deflating. And this is what we think is happening now in the US specifically. If we look at the US private sector debt as a percent of GDP is up at 220%, same rough level where it was with Japan. And so we have the situation where there's excess credit in the private sector. Now, you alluded to in your introduction about the amount of public sector debt that's coming through, and that's fine. We can talk about modern monetary theory or the magic money tree, as I call it, or many people do. But in Japan, public sector debt has ballooned over the last few decades, but private sector debt deflated. So that's why you had this period of deflation in Japan. So what about what's happening just now? So if we look at what's been happening around the world over the last few decades, it really is, it blows your mind. It blows my mind to think that Japan's been in a bear market for 30 years. Since the very last day of 1989 was its top, and it's obviously nowhere near exceeding that. The Eurozone, as displayed by the Eurostoxx index, has been a bear market for 20 years. Now, I remember being in the markets back in when the bubble burst in the internet bubble burst in 01 and 02, and when we had the drop there, and everyone was saying, well, it's fine, don't worry about it, because the central banks will never let us turn into Japan. Well, guess what? The Eurozone has turned into Japan for many years already. China topped out in 2007. China's been in a 13-year and counting bear market. So this idea that stock markets can't have a long-term bear market is a fallacy. And so we think the US is topping out just now and going to be joining the world in this bear market. This is the crux of it. It took me a while to get here, but this is the crux of our thesis. And this shows the Elliott Wave count for the Dow Jones Industrial Average going back to the early 1900s. So 1929 was what we call Supercycle Wave 3, the Supercycle Wave 3 top. And 1932 low was the Supercycle Wave 4 low. In terms of Elliott Wave, we can count 1, 2, 3, a sideways movement for 4 here. And all of this movement since the 1980s has been cycle degree wave 5, which itself will complete a supercycle degree wave 5 as well. So it's an extremely significant top that's happening at the moment. What makes it really interesting, and then this is where, as I alluded to, when we're looking at potential wave counts, we can look at other information to give us clues. And one really, really big clue as to why this might be a big top or a supercycle top is that this is the first outside year since 1982. Now, I'm sure your viewers will know what an outside bar is. An outside day would be when the high and the low of the day's action is outside. So it's higher than the previous day's high and lower than the previous day's low. The high and low were outside the previous markings. The fact that this is the first outside year since 1982, when the bull market really started to get underway, is significant. But it's the fact that this is also the first, it's not only engulfing the high and low this year, not only engulfs last year's high and low, but also the previous 2 years' high and low as well. So this is a major clue that a peak in sentiment has been reached. Now, talking about sentiment, let's look at the Wilshire 5000 index as a percent of US GDP. Going back to the 1970s here, this is the Warren Buffett indicator, a measure of valuation of US stocks, if you like. Well, I mean, the chart speaks for itself. But also, it's interesting we can count a 5-wave movement in Elliott terms with wave 3 here subdividing into 5 waves, which we would expect from an Elliott wave perspective. So this movement here tells us that this is actually potentially having a top. Sentiment in terms of NASDAQ volume, I mean, everyone knows how narrow the rally has been. We know about the call buying. From your world, Patrick, the IPO craze, would you call it a craze? You'd call it a boom.
Yes.
It's all analogous to a top. SPACs have come back, roaring back into the market. Blind pools, as they called them in the late 1920s. But the NASDAQ S&P volume ratio is much higher now than it was back in the peak 20 years ago. So that in itself is warning of a top.
So just to stop there for a second, I mean, you just mentioned blind pools. I mean, do you think that this sort of concept of SPACs and these sorts of things are sort of the blind pools of the 2020s, like they were 100 years ago?
It's very analogous to it, yes. I would say. I mean, to have blind faith in investors giving their money to a pool, a fund, whatever you want to call it, and not knowing what they're going to be investing in, that in itself speaks of massive optimism that whatever the fund manager or the pool operator is going to choose to invest their money with is going to be successful. That's essentially what this boom in SPACs is saying. And
so that. So that's driving, and it's driving us. I'm quite excited now because we're at this huge super cycle top. So carry on with your next chart and keep showing us this amazing dispersion.
Well, that's right. Now, another clue as to why we think that the US stock market is finally topping out is the fact that we can look at the stock market priced in Fed tokens, dollars. These can be printed, as we can see, as we have seen over the last decade. They can be printed as much as they want. So these are Fed tokens. This is the Dow priced in Fed tokens. This is the Dow priced in something that can't be printed. And you might call it honest money. You would certainly call it real money. And so this is the Dow priced in gold, which is a currency, a form of money. So you can see that Europe topped out 20 years ago. And really, if the Fed hadn't been printing all this money, then perhaps the stock market might not have gone up in dollar terms, in US dollar terms, as much as it has. Certainly in gold terms, it has gone down. So you could say that over the last 20 years, certainly over the last decade, that this has maybe been a bit of an illusion that's been going on in the US stock market. Now, 20 years ago, or in 2001, 19 years ago, Robert Prechter made a forecast on the Dow Gold ratio when it was up here in 1999, predicting that it would come down in this movement, what we call a C wave down here. This is what was called an expanded flat correction, not to get too technical in Elliott Wave terms. And this is the updated forecast since then. So we've come down here into that was at 2009 and back up in a corrective advance. And so what the forecast is saying is that the Dow Gold ratio, or Dow priced in honest money, should continue to go lower over the next few years. Now, you could say, well, that's because some people might say that's because gold's going to go, to a gazillion or whatever it's going to be that people are talking about. Then that could happen. We'll come on to our gold forecast in a minute. But really, given our Elliott Wave forecast of the US stock market, it means that we're probably going to be into a much bigger, much deeper decline than people actually think in the stock market. So that's the US. Moving on, just to briefly move on to a couple other markets, we've got the DAX here and the FTSE. What we're thinking about the DAX is that the movement down to the low in 09 was wave B, and what we're of a cycle degree wave B. So this is what we call primary degree wave A, primary degree wave B, primary degree wave C, which is the circle, should form of 5 waves, and we have 1, 2, 3, 4, and a 5. So we think that the DAX has completed a 5-wave movement higher from 09 to complete primary degree wave C, which is cycle degree wave B. And what that means is, again, what we're talking about is an expanded flat correction. That means that the DAX should now be set for a fall in wave C, which should take it towards the 09 lows. Now, it looks like the market has gone a lot higher than it did the top back here in 07. And that's true, but we always have to remember that the DAX index is a total return index. If we looked at the DAX price index, actually the market has just made it to where it was back in that 07 high. The FTSE itself is very similar. You can see how the market's really gone kind of sideways over the last 20 years. We think this is cycle degree wave A, cycle degree wave B, and the market. The FTSE topped out 2 years ago. It's been in a bear market for 2 years, already. People forget about that. But we're subdividing into a decline in the market, which could start to accelerate pretty rapidly over the next few weeks. I've just got a couple more charts to show, and then we can maybe look at some more questions. But Euro stocks itself, this is an interesting chart from a socioeconomic point of view. This shows the triangle which is happening in the Euro Stoxx index. So when you see a triangle in a chart, it means it's a continuation pattern, which means that the market should exit the triangle from the direction it went in. So obviously the market had rallied into this wave 3, as we're calling it, top in 1999. So eventually the market will go higher again. But this sideways movement is what we call a triangle, which consists of 5 waves. Now, this speaks to optimism and pessimism. The euro was launched at the high. As we approached the first low back in 02, 03, we had a lot of no votes on the constitution of Europe. At the top of wave B, we had more optimism. We had Bulgaria and Romania being admitted. At the low, just after the low point of wave C, we had the Eurozone crisis. And at the top here, last year, we had, you could call it, a lot of Eurozone unity amidst the negotiations over Brexit. So what we think is happening here in the Eurozone is that we have completed the first 4 waves of a triangle. We're into the final wave. So the good news, and there is good news, it's not all doom and gloom, is that we're in the sort of final wave of a decline in the Eurozone. But that decline could still, bring the market down at least 50% from where it is at the moment. So once it's over, then the market will be free to move again. Now, what's going to be interesting is what kind of sentiment, because this is all going to be driven by a negative social mood, because that's what drives market. What's going to happen around here? Will it be the breakup of the euro or a partial breakup of the euro? It could be. We don't know what the answer is going to be to that. We just know that the wave E low, if this is correct and there is a triangle going on here, there'll be lots of dramatic news going on in the Eurozone over the next couple of years.
So, I mean, just looking at that very quickly on the whole Eurozone thing, what you're saying is that imminently, I mean, in the next few months, there could be some really quite downward moves. I mean, we're on the cusp of a downward move at the moment, if not already in it.
Absolutely, yes. We certainly, the wave counts. I'd encourage viewers to look at Elliott Wave International. European short-term update looks at it 3 times a week, and we are been moving down. The sideways to down movement that we've seen since June really is the start of a much bigger decline. We think there are obviously levels where if that broke on the top side, it would invalidate the directly bearish movement. But certainly, as things stand today, on the 13th of October, it would appear that we're on the cusp of a movement down over the next few weeks.
Very, very interesting altogether. So let's have a quick pop over to China then. I think you were going to show us Shanghai, and how do things look out there?
Well, again, interesting. As I said, previously, it topped out in 07. So we've been in this holding pattern, and we think it's again a triangle. We've had wave A here, B, C. We're in wave D, an advance in wave D of the triangle, which, we might have a little bit more of an advance in wave D. Once that tops out, we'll have another movement down, small movement down, relatively small movement down in wave E. So, bear markets are sideways markets are bear markets. They're corrective markets. And this is what's been happening in China. And so once China completes its movement, it'll come out into another bull market. And a lot of people say to us, what about correlations? What about the fact that how can China or go sideways to up? How can Japan go up? We think that Japan's already finished its bear market. How can Japan go up? If the US market is going to collapse, if the US market is going to go down a long way and for an extended period of time. And we say, well, we don't really look at the correlations because that biases our thought process. We look at each individual wave pattern on its own merit and let the correlations fall out. And of course, we flip it round as well. We say, well, how come China's been going sideways for 13 years? The US market's been going up. Europe's been going sideways for 20 years. The US market's been going up. There's no reason why the US market other markets can't go up or sideways to up as the US market is coming down.
Fascinating. So we're into the last 5 minutes of the show. If anybody's got a question, now is the time to ask as we move on to the bond universe. Okay.
I'll just flip through the last few very quickly. Bonds, we think certainly still in the final wave down, but once the low in bonds is in, and this is the global aggregate index yield, so this is the entire bond yield. Obviously, if stocks are going to come off, then it'll affect credit spreads, it'll affect triple Cs, all the junk bonds. We'll start to see the weakness there first, obviously. Euro dollar, we think is primed to move lower in what we call intermediate degree wave C. Here we think we've seen the high, the recent high, and we should be coming down right now. The CRB index, everyone's talking about inflation again. Now, look, the CRB index topped out back in 2008. And we think this is what we call an ABC correction. A, B, wave C consists of 5 waves. We've had 1, 2, 3, 4. We think we're still in the 5th wave. And you can see this channel here. If we're correct, then the channel is a potential price target for the CRB index. So commodities could still come down. Should the market start to go up, we think that'll probably signal stagflation in the world. Subpar growth because equities are still going to be coming down, but higher commodity prices. But at the moment, we still think the CRB is coming down. Oil, we think this was a super cycle wave top back here in 08. We've had the first movement down, an A, B, and a C. Wave B was a triangle. Wave A here, this is the 3-month contract, so it smooths out the negative movement. We've had a movement up here. Right at the moment, we think that the market could come down quite significantly within this, what we call a wave B. We're in a wave B here, but right at the moment, we think the market could come down over the next few weeks and months. And gold. So we think that we had a very significant top here in gold back in 2011. And so far, we've seen what we're looking at here is an expanded flat. We've had wave A down, wave B up. Why do we think this is a top? Well, one of the reasons, again, as I alluded to earlier, was looking at sentiment. So many people are bullish gold. So many people are calling for unbelievable, incredible levels of gold. 20,000, 40,000, 100,000, I think I've seen recently. So, gold is looking like a top to us at the moment. And final chart of the day, of the show, is Bitcoin. And we think that Bitcoin's still bullish at this stage, judging purely by the Elliott waves. 9858 is a key level for us. If it moves below there, then Bitcoin's probably going to be in what we call, again, a triangle, wave D here, which means it will come down in wave E before moving higher again. So, Bitcoin either bullish directly or more sideways, more down to sideways movement, and then higher again. So that's my quick roundup, not so quick roundup of the markets.
Well, that's quite a tour de monde in one fell go. And you're showing us now the link to Conquer the Crash, which is, I think, a very, very famous book by Robert Prechter, talking about, Elliott Wave and all of the issues that relate to it.
Yes, I would certainly recommend people look at Elliott Wave International. You can look at Conquer the Crash through there, and there's some. If we're correct, we're entering this period of deflation, dead deflation. Then there's some great tips in there as how to survive and thrive during that period.
Which is very interesting, because we've got one final question just come in from Martin Watkins again. Thank you, Martin. Would negative interest rates from more central banks have any effect other than effectively lagging the fifth wave?
Negative interest rates are an interesting concept. I mean, they certainly speak to us of the fact that this is actually deflation in the making. You could say that that QE perhaps has extended asset purchases and kept movements going. We would say, from a socioeconomic point of view, we would say that social mood actually turned in 09, in March 09, to the point that it started to become positive, allowed the Fed to be seen, and the Fed and other central banks to be seen as the saviors of the market. So, the jury's still out on the negative interest rates. I mean, certainly you could say that it affects people's ability or affects people's motivation to save. You could say that negative interest rates actually encourage people to save more. So we think the jury's out.
So the jury's out on that, but at the same time, we're looking at the idea that it could be something close to this mega super cycle top. I mean, I feel privileged to have spoken to you on October the 13th, because I don't believe there's any point in time in history that we've seen so many super cycles all seemingly come together at the same time. I mean, that's quite incredible.
Well, yeah, I mean, yes, there is a confluence of things coming in at the moment. Certainly, with but everything's in a different degree of trend. If you look at what's happening in the Eurozone, for instance, the Eurozone chart that I showed, that's in much further along its bear market than the US is. The US is just starting its bear market. Japan's already out of its bear market. China's further along in its bear market. So, but right at this specific moment in time, yes, there is a confluence of tops going on.
It's absolutely fascinating, Murray. Bringing in the socioeconomics angle has been quite intriguing altogether. Thank you very, very much for this really, really intriguing hour. Certainly, it's really worth going and looking at the report from the Socioeconomics Foundation talking about the US election. It's very thought-provoking, if nothing else, and I would imagine it'll be a trigger warning to a great many people out there who think that the US election is already done and dusted, and certainly be interesting to see how that does play out in the course of the next 3 weeks. Very interesting to hear that we may be on the cusp of another brief downturn in the European stock markets. Not good news for the USA, because it sounds like we're in a mega top. And of course, we're basing that on the back of many books, analysis and writings in the past. Indeed, Robert Prechter, as you mentioned, has been a forerunner in the world of popularizing Elliott Wave throughout the course of my career, and indeed before, and of course yours as well, Murray. It's a delight to have had you with us today discussing this really, really interesting topic and looking at so many markets that certainly, if nothing else, the good thing is we're not going to be bereft of volatility in the course of the next few months. One area in which, of course, we do have a great deal of volatility is COVID-19. And unless you're struggling to keep up with the current state of lockdown in the COVID-blighted north of Europe, for example, the area to the north of England, from which, of course, Murray hails, and indeed some of my relatives, the Stuart clan, were originally from, that bastion of PC governance Scotland. Well, if you're trying to understand the COVID rules right at the moment, perhaps I can help you with A Man Walks Into a Bar. Lucky, lucky man. Thank you for watching, ladies and gentlemen. On that note, it's been a terrific IPO-VID live stream 009. Thank you to Bata in production, to Ola for keeping us all organized and on schedule. From myself, Patrick L. Young, thank you to Murray Gunn, my brilliant guest today, the ace technical analyst for Elliott Wave International. Go and check out their various links that we've been showing you throughout the course of the show. And indeed, look to Conquer the Crash by buying some of those books by Robert Prechter, amongst other products from the Elliott Wave's ace analysts looking at all markets the world over. We'll be back next week. We've got a magic and fantastic show then. We're going to have the CEO of the Aquis Exchange, based between London and Paris, Alistair Haynes, joining us, Fabulous, another discussion in market structure. But in the meantime, watch out for those supercycle tops, ladies and gentlemen. Socioeconomics says that it's all going to be a very exciting and volatile, if not end to the year, certainly early 2021. Murray, again, thank you very much. My name is Patrick L. Young. Look forward to catching up with you in exchangeinvest.com during the course of the week. This is IPO-VID 009.